It's time now for Retirement Ready, brought to you by Fidelity Investments. Today, we're joined by Lloyd. He's a wealth advisor and investment analyst over at Strategic Wealth Partners. And Luke, you're right that the pandemic is a wake-up call. And I guess I would ask, for whom specifically? And I guess we all sort of looked at life and, whether we're saving for retirement or not. And now everything seems quite a bit different. But just from a retirement lens, the conversations you're having with clients, what have been the takeaways now that we're 4 months into this and we have a little bit of visibility on what happened and what didn't?
Right.
How have you been thinking about this from a retirement perspective?
So again, like you mentioned, it's for really everybody. So it's not just maybe the older generations or the younger generations, it's everybody. So what I mean by that is, you need 3 to 6 months of emergency reserves, no matter who you are in savings. And I think a lot of people did not have that 3 to 6 months. Now, thankfully, the PPP program, along with the stimulus from the federal government, kind of helped bridge that gap. So nobody really felt the pain that really needed that. I mean, there were people, but for the majority of people, they kind of were saved by that. But going forward, there's so much uncertainty. So we might be closing down again. You see states like Florida, Nevada, Arizona, all these states starting to close down again. And there's so much uncertainty that, who knows if this July, unemployment benefits are going to get pushed back. I think they will, because no party wants to, make 20 million people mad. But that's besides the point. So when it comes to the older generations, though, it's the same story. You have to be proactive rather than reactive. And so many people right now are being reactive. A lot of the people I've talked to, they didn't look at their accounts from February, March, April, May. They didn't want to look at it because they're scared to even look at the accounts. So they kind of just ignored everything going on, and they're finally looking at it because the stock market has fully recovered.
And when you think about that behavior, and we've talked to a number of folks kind of about this dynamic, that the stock market rebounded so quickly. And I've been wondering have people internalized the idea that the stock market will eventually go up, and so they're not as quick to bail at the bottom? I mean, what do you think is kind of driving that from a psychology perspective?
Well, everybody's personal situation is going to be so much different. So it's hard to generalize, what's right for you or what's right for the guy next to you. So it really depends. But when it comes down to it, I think right now the feeling is that, stocks only go up. I mean, that's how everybody feels. Now, let me hit on that real quick. Stocks are meant for growth. Stocks are meant to go up, right? So the saying in itself is not necessarily wrong, but where you need to get right is the asset allocation and asset location, and things are changing. Things are changing, especially now, given the uncertainty, the coronavirus situation has kind of, made it more important for you to go overweight certain sectors like tech, for example. The whole infrastructure is changing. Tech is going to be greatly benefited for the future. And the people over the past 5 or 6 years who didn't want to get into tech, they missed out on a ton of opportunity. They weren't in there because tech is so expensive, but it's the same story. Tech's very expensive, but it's where the growth is right now.
When you think about allocation for a lot of retirees or retirement savers, folks who they have a job and they have a 401k, right? They're basically looking at, what should I have in stocks? What should I have in bonds? What should I have in other? There's been a lot of talk about the 60-40 is dead. You shouldn't be thinking about things that way. What have you seen on that side? And are people as invested in the stock market as the actuarial table would say you should be at certain stages of life?
So that's actually something that truly frustrates me. So, people in your 20s might be 90-10, 30s 80-20, 40s might go 70-30. There's like this mindset that you're supposed to do, the same thing across the board. And again, every situation is going to be different. You're going to have different incomes, different expenses. You're going to have a different financial plan all around. You have different goals in retirement. So because things are so different, there's no one strategy for you. But what it comes down to is really taking all of the variables and, again, coming up with that proactive versus reactive. You want to be proactive. You want to change. The thing is, the past 10 years, passive investing has done so well. Going forward, I don't think it's going to be the same story. I think active management is so important going forward because, again, you don't want to own everything right now. These next 5 or 10 years, you don't want to own everything. So from a retirement perspective, you do have to take your individual situation into account, but you don't want to hold losers. You'd rather hold winners. That's my personal opinion.
All right, Lloyd with Strategic Wealth Partners. Thanks so much for joining the program. Have a great holiday. Talk to you soon.
Hey, you too. Thanks for having me.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.